Since there's so few of you today, sometime today, I didn't bring an attendance sheet, but if you all will email me and just remind me that you came today, I'll give you all some extra points. Okay, so first of all, thanks for coming, those of you that did. I was probably fairly even money that whether I was going to show up or not. So I don't blame anyone that didn't show up, but I'm glad that someone did at least, or some of you did. We were supposed to cover Chapter 16 last week, and I didn't look to see who it is. It might have been one or two of y'all, but a couple of people already did the quiz for Chapter 16, maybe thinking that we were going to do it last week. Anyway, I got behind last week when I was going to do the lecture and post it, and then I talked to Teresa, who teaches the other principles class, and even being behind, we're actually still a little bit ahead of their class. So I figured instead of posting it, I'd just give you guys an extra week. We do it in class. Anyway, we're going to talk today about reporting the statement of cash flows. This is kind of a tricky chapter because, well, it's tricky for me to teach. I shouldn't say it's all that tricky for y'all. But anyway, the way I teach principles, typically I just want you to kind of know what's going on in all of these scenarios, in the journal entries, financial statements, all of that type of stuff. But I don't necessarily expect you to be good enough that you could go out and be an accountant doing this stuff right now. Obviously, principles covers a large percentage of what accountants do in their day-to-day activities. So if all you had to know was what was in principles to be able to do that stuff well, then any other classes would be pointless. But this is just supposed to be kind of an overview of this stuff. Anyway, this chapter in your book is dedicated to teaching how you would actually, if you were an accountant basically, put this stuff together. So as a professor teaching it, I'm trying to balance the concepts, and I'll skip through some things and try to go around things. But I don't necessarily want you to, I mean, obviously it's great if you can, but I don't necessarily care that everyone is competent enough that they could go out and actually do this accounting stuff proficiently. More I care about whether any of you at the end of your business school career get into a job and are faced with financial statements and can intelligently look at them and kind of understand what's going on. That's what I care about the most. So anyway, with that in mind, it's actually not that long of a chapter from the standpoint of what I'm going to cover from it. But we'll talk, obviously, a little bit about statement of cash flows. Why is that statement of cash flows important? Well, obviously, you guys probably have heard the term cash is king. If you haven't, you've heard it now. Cash is king. Why is that? Because if you go and talk to business owners of failed businesses and find out why their businesses failed, some of them fail because they have a bad business idea and it just nobody wanted it. They made something nobody wanted, or they provided a service nobody wanted. And that's, probably half of the businesses that fail because of that reason. The other half fail because they're really bad cash managers. And what that means is you can have a company that does really well as far as you may be able to look at their balance sheet and say, well, they have a ton of assets and not that many liabilities. They don't owe a lot of money. They have a lot of assets. You can have a lot of assets, but have none of them be cash. You have a lot of land, a lot of buildings, a lot of machinery, that type of thing. Those are all assets, but they're not cash. If you have $500 million worth of really specific heavy-duty equipment, whatever your company is, construction or some type of company that uses this type of equipment, but you don't have cash to pay the rent or the mortgage on your facilities. Well, the bank is not going to accept a slice of your big machinery rig as payment. You have to have cash. The electric company is not going to accept a wheel off of your bulldozer. You have to have cash. And so what a lot of times happens is these companies, for whatever reason, see that their sales are doing well. Maybe they sell a lot of credit sales and they haven't collected on these sales, but they're doing really well revenue-wise, sales-wise. They have a lot of assets, so their balance sheet looks good, and they end up going out of business. Well, it's because they don't understand that no matter what else is true, you cannot, at least at this current day and age, you cannot run a business without cash. And I don't mean necessarily paper dollar bills, but liquid dollars in or whatever currency in a bank account accessible so that you can pay salaries or do whatever else it is you need to do, pay bills. So it's so important that one account, cash, is so important in a business that one of the four main financial statements we have is solely dedicated to basically, you look at the T-chart of cash and tell me what's going on there. Well, that's what the statement of cash flows is. Okay, tell me all about what's going on with cash. So obviously that in and of itself should tell you this is really important. Okay, you don't see a statement of land flows. You don't see a statement of any other type of flows. You don't see any financial statement dedicated to one singular account except for the statement of cash flows, because it's so vital to successfully running a business. So, some of the things it tells you. How does a company receive its cash? Where does a company spend its cash? What explains the change from beginning cash balance to cash balance at the end of the time period? We talked about why cash flows are important. So, when we talk about statement of cash flows, we also consider cash equivalents. What are cash equivalents? Essentially, anything that's short-term, highly liquid, readily convertible into cash, and close enough in its ability to change into cash that doing so basically will not change the value of it at all. Okay? So, any type of CD or other account that is not necessarily cash, but can be changed to cash in the blink of an eye if you need to, it can be considered a cash equivalent. Okay, so on the statement of cash flows, we divide it into three categories. We want to know, and we divide, because of relevance, we divide effects of cash activities in these three categories: operating activities, investing activities, and financing activities. Okay? So operating activities would be your day-to-day operations. So obviously that should make sense why we care about that. Are your day-to-day operations sufficiently bringing in cash, or if not, certainly you have some other means of bringing in cash, at least in the short term. But the operating activities will tell you a lot of what you need to know about a company in the cash coming in and the cash going out from operating activities. Investing activities, depending on the company, that could be essentially non-existent, or for instance, like you look at a company like Google, for instance, or some other big tech company, that part of its business model is kind of buying out and swallowing up these smaller tech companies and incorporating their products into their overall product. So a company like that, they're going to have a really sizable investing activities statement of cash flows, because any transaction related to the buying and selling of these companies, buying stock in these companies, etc., is all going to be captured in there if it involves cash. And then financing activities. We talked about this before, but a company generally needs money to make money. Okay, very few companies bootstrap all the way through. And what that means, if you're not familiar with the term, is essentially not taking any source of outside cash from anyone. Start with $100 in the owner's pocket, and he turns that, or she turns that $100 into $10 million or $10 billion and is on Shark Tank. Okay? Very rarely does that happen. Usually what happens, you start with a good idea, you have enough built up or revenue, or early investors like family, friends, etc., to get you to a stage where you are big enough that you can acquire some other type of financing, either cash from an investor or cash through debt financing. Okay. Anyway, however you choose to finance, those activities are captured in the financing activities category. Again, this is pretty self-explanatory, but basically inflows and outflows of cash in the operating activities section deal with the receipt and spending of money related to whatever it is you do as a business. Okay, so any operating expenses that you have, and then even things that are only kind of tangentially related to your business, like having to pay taxes and fines. Let's see. Collection, yeah, all of that's pretty directly related. Receipt of interest revenue, only, kind of slightly related to your actual operating activities. But for the most part, this section captures what you do on a day-to-day basis. And that's why that section typically for most companies gets the most attention. Investing activities we talked about, but essentially this is any time that you are making or making money or trying to make money from buying or selling assets. Okay, this could be securities, this could be actual land, real estate, etc. Anything like that. And then finally, financing activities, we talked about that, and that's anything related to you trying to generate outside revenue or investment in your company through debt or through stock, and the associated, generally the associated fees with or the directly related fees with those transactions as well. This is just kind of thrown in there to make you aware of the fact that there are some non-cash investing and financing activities that don't involve cash at all. That doesn't mean that these things aren't important and don't significantly alter a company's future or have the potential to. Just means that these don't involve any changes to the actual cash account. Okay, so let's see. If you were asked to prepare a statement of cash flows, which I'm not going to ask you to do in this class, but if you were ever asked to prepare one, the easiest thing to do, in my opinion, is to find a kind of a template like this. Okay, so this would probably be a good reference sheet to have, not only in this class, because it might not necessarily benefit you that much in this class, because I'm not going to ask you to do it, but this may benefit you in the future. Anyway, those are the various headings for those three categories. That should make sense. And then just a list of the individual inflows and outflows associated with each of those activities. So it's essentially just a list format of all these transactions involving cash, or at least the net effect of each of these types of transactions. And then these bottom two categories, that's basically saying everything above this plus this balance at the prior period end should give us the balance at the current period end. So this whole statement is essentially a reconciliation between beginning cash balance and ending cash balance. And everything that affected that should be listed out under its individual category in the individual statement. Yeah, I wouldn't worry too much about these steps. Again, this is more for a practitioner. If you're going to be an accounting major, we will definitely hit this much harder in intermediate. This is basically just a slide letting you know that obviously, and again, I'm not going to ask you to do this, so I'm not going to spend a lot of time on it, but if you're asked to prepare a statement of cash flows, you need to be able to know where to go to find the information. Obviously, if we're talking about the goings-on of the cash account, the place where we're going to find most of the information related to that is, of course, in the cash account. So if we just pull up, that's just kind of a generic look at what a computerized accounting information system might look like. Most of them look a little better than that, format-wise. But anyway, that is just a computer printout of the goings-on in the cash account for whatever entity this is. And I wouldn't even look at that side. I should have deleted it. That's just going to confuse you. If that helps you, great. Looks confusing to me, though. Essentially, when you talk about the information you need to prepare the statement of cash flows, when we say we need the comparative balance sheets, in a way that's true. All we really need from that is a beginning and ending balance of the cash account. So that gives us the amount of money that we need to account for. And then most of that money is going to, the tracking of that money getting spent is going to be found within the income statement, for the most part, under either the expense section or the revenue section of the income statement. Okay? In addition to that, just drilling down into the cash account and looking at anything that didn't get picked up in the income statement, which experienced professionals that do this know which accounts are typically the ones or which areas you should typically look at to find or to catch cash transactions that wouldn't be captured in the income statement. Again, since I'm not expecting that of y'all, I wouldn't worry about that too much. Okay, so your book introduces the fact that there are two methods of doing this, the direct method and the indirect method. I detest the indirect method and don't ever ask anyone to do it. I leave it on there just because your book talks about it. To me, the direct method makes a lot more sense. In the direct method, you essentially are just starting with and only isolating and looking at what's happened with cash. It's a little bit harder to find the information at the outset when you're doing this method, but the difference is the indirect method basically says, okay, look at the income statement. Take the net income as your starting point, which you see right here, and then make any necessary adjustments to basically get rid of everything from net income that wasn't associated with net cash provided by operating activities. Okay? So in the indirect method, you're starting with net income and then you're backing everything out that doesn't fit. With the direct method, you're just looking at the categories and basically going out and finding the information. Okay? You have the category, cash received from customers. You would just go out and find that information. Cash paid for merchandise. You would go, for both of those, you would go to the income statement and look and drill down into the information and find it that way. To me, that makes more sense, at least from a reporting standpoint, because it's, by nature more direct and straightforward. So for that reason, I won't talk any more about the indirect method, and from this point forward, we'll just assume that the direct method is what's being used. Yeah, I don't know what this is. It's not just this book, but this book does it. But pretty much every accounting book does this. I think it's just the nature of accountants and the way that they think. But the accounting textbooks really like to make these processes and say, oh, it's just this 3-step process, this 5-step process, whatever. And usually most of these steps are just self-explanatory, obvious things. And they just kind of include those to have an extra step so it looks prettier, I guess. But anyway, I wouldn't use necessarily a 3-stage process, but I would just think about it this way. This one stage right here is basically all you're doing. Identify the changes in any investing-related accounts. So pretty much, if you're working for this company or you're working with this company in any capacity, you should know how this company gets their money. How do they get their financing? Are they mostly getting money through stock investments? So they sell stock, people give them money, and then they're basically owning less of the company that way. Or do they get most of it through debt financing and it's through bonds, etc.? Once you know that, then it's pretty easy to look and say, okay, well, we typically use bonds to finance. Well, if I'm doing this statement of cash flows, all I really need to look at is any changes in these bonds accounts. If there's been any changes, I need to make sure and see if that affects the statement of cash flows at all, if it's a cash-related change. And if it is, then I'll go back in, see what it is, and whatever it is, I'll put on the statement of cash flows. So that's where they get the 3 steps from, but it basically boils down to know what type of financing what type of investing you do. So do you invest in other companies? Do you invest in bonds? Do you invest in stocks? Know what type of investing you do, and then look in those areas for any changes and report what they are if they affect cash. And you'll do the same thing with the financing side. Okay, so let's see. Anytime in these slides, if it says anything about reconstructing, they're talking about using that indirect method where you're basically having to back everything out. So that's why I'm skipping over those. With financing, again, basically the same thing. Look in the financing related accounts. You should know if you're associated with this entity what those are and which ones this company typically uses. See if there's any changes that took place, and if there is, see what their effects on cash were. I'm not going to ask you to do any of these types of journal entries that I'm skipping over here. These are all just them trying to reconstruct. Basically, for y'all, at y'all's level of understanding, or at least the understanding I want you guys to have, I'm not going to ask you to do anything associated with reconstructing or trying to generate anything basically associated with these financial statements. So as long as you know the categories, you know typically what goes in each category, and you can look at one and not be totally confused, you guys should be pretty solid. Anybody have any questions? All right, I will see you all next week. If something comes up, let me know.